Hello and welcome to this Markets Today special from the India Today Group. I'm Udayan Mukherjee, and with me is one of the longest standing and most respected mutual fund managers of India, S. Naren of ICICI Prudential AMC. Naren, thank you very much for joining in today, and good to see you again after a long time. Since we are speaking after a long time, let me start by asking you about the experience of the last couple of years and what you see ahead. Because, the last 2 years, despite the recent rally, returns have been sort of lukewarm for Indian equity investors, 10-11% kind of return over a 2 year period, which is a bit subpar. So, are you confident that the next couple of years will make up for what has been a fairly pedestrian run for the last 24 months?
Actually, go back a few years back, 2 years back, you'll find that the market was overheated and there was a fair amount of exuberance at that point of time. And you had the IPO market bringing out IPOs where there were no earnings and people were willing to invest, particularly in the new age companies. So at that point of time, there was a certain amount of exuberance. And we also had a situation where the central banks, particularly in the developed world, had taken a call that they can print any amount of money and invest any amount of money through quantitative easing, which resulted in a big inflation. And subsequently, they had to tighten monetary policy, and that resulted in a fair amount of correction in equities across the world. So in that period, actually, India has been one of the beacons of markets doing better thanks to domestic investors. And actually, the returns that you've seen in Indian equity markets and in Indian small cap and mid caps have been about one of the best in the world at this point of time in the last 24 months. So while it may appear that the returns have been modest, I would say it is one of the best returns that you've got anywhere in the world. If you look at the future, I would say that we are in a very structurally in a very good shape, and you know that geopolitically we are in a very good shape, and from a macroeconomic point of view also we are in a very good shape. And but the having said that, the challenge is that from a valuation perspective. We are one of the costliest markets in the world, and outside the US, I would say we are one of the costliest markets at this point of time. So even going forward, it's tough to believe that you can get very big returns in the long run, in the medium run, I mean. But it is still India is one of the best markets to invest in for the long run, and because it's a very good structural story. But if the valuations were to become more reasonable, I think India would be a great market where you can get both good long-term returns and big long-term returns. Whereas today, because of valuation, it's difficult to predict very high returns at this point.
Do you expect valuations to moderate at all, Naren? I mean, it can happen two ways. The markets can go sideways and give you modest returns for another few quarters, and over a period of time, earnings will bring down valuations. Or there could be a price correction which brings prices to more attractive levels. Do you expect either of these two to happen?
Actually, these things cannot be guessed accurately, and I wish I could guess them and say this is what is going to happen. I think one of these two would happen, and if markets do correct and they become attractive, then it becomes very easy. Otherwise, you have a time-based correction. So if you look at the real estate market, if you about 10 years back, they had become very costly, and they went through a time-based correction rather than a price-based correction. And so whether you want to have a time-based correction or a price correction, it's difficult for any market observer to give a call accurately, and that depends on how market participants behave. And rather than what we can say, because see, it is market participants which decide what happens to stocks. And if the market participants choose to decide that I'm going to sell whatever be the price, then you're going to have a correction and then you're going to make the markets cheap, which gives scope for big returns. On the other hand, the market participants say, no, we are going to remain invested. Then you're going to have a time based lower return period. But it is not that the returns are going to be low because very low, because at the end of the day, even debt returns are not very high. So if you look at the post-tax returns for most debt investors, that is not a very high number. So it is not. That's one of the reasons why we think that funds which invest both in equity and debt may be a good way to invest at this point of time, given that the post-tax return on debt for most of the taxpayers is a very low number at this point in time.
This is an interesting point, Naren, because you run these dynamic asset allocation funds as well. At this point in time, given what you just said about equity valuations and fixed income interest rates, returns, what would your asset allocation be? Would you lean more towards fixed income or more towards equity?
It is marginally in favor of arbitrage and fixed income at this point of time, given that valuations are not that cheap. But if the markets were to correct a little bit more, it would lean more in favor of equity. But it is about the kind of asset class that we actually like investors to invest in if they had to choose some ways of investing at this point of time, because markets are not cheap. So it's tough to recommend lump sum in equity. Debt post tax is not a very attractive asset class at this point of time for people in the higher tax rates. So debt is not an attractive asset class. So you have to choose something in between at this point of time.
If you had to guess, and I know it's an impossible question to answer, but over the next 2 to 3 years, which we can classify as medium term, do you think the chances of Indian investors getting 10, 11% kind of returns from equity are higher, or 50% plus kind of returns, which is essentially the desirable return for most Indian equity investors?
See, the way we look at it is, what you get in an alternate asset class. So, everyone would want 15, 20, 25%. I mean, and what is the alternate return you can get in most asset classes at this point of time? So I think this whole debate on trying to expect 15, 20% return is not required at this point of time to justify investment, let's say in a in a product like which invests in both equity and debt, because you're not like in equity like late 90s. In late 90s, you could get 16 to 18% in many debt products. So at that point of time, I would say it was necessary for you to get 20% per annum to invest in equity. Today, you're not getting that kind of return. So as long as you get better returns than an alternate asset class, I think it is fairly attractive. And having said that, there are so many geopolitical imponderables which none of us know. And what can hurt markets in the near term? Do we know? The answer is certainly not. Did anyone expect the Ukraine war? The answer is no. Did any of us know that this could be a problem in 2022? The answer is no. So I think we all think that we know what will happen to markets, but periodically certain things happen in markets which we can't predict, and that is the reason why systematic investment plans and asset allocation are the two best ways to invest for most people in the long run.
You said something interesting just a while ago, Naren, that for 10 years, the real estate market did nothing. And some of these features also happen in sectors. I mean, there are pockets in the past where FMCG went through 10 years of not delivering any returns. We can see some signs of that over the last couple of years, where some of these very highly valued consumer-facing companies have started underperforming. Do you expect that this to continue? Because they are the ones which were giving you the greatest returns in 2018-19 before their underperformance started. I mean, do you expect an Asian Paints to underperform for 8-10 years like a Hindustan Lever did back in the day?
The fact is that if incomes don't grow at 15-20% per annum, is it possible for all the consumer sectors to also grow at 15-20% per annum? If you go back to the 90s, there was a period of time when you had so many car manufacturers suddenly coming up and starting, but many of them did not do well. I think it's a fallacy to believe that all consumer facing sectors can always deliver 15 to 20% per annum returns. And the last 2 to 3 years, going back around 2.5 years back, it was a tough task to explain to people that any quality stock at any price will not deliver returns. And now, after 2.5 years, now people are more amenable. But the reality is that people have to believe in more moderate returns. Of course, the last 3 months' returns have been fantastic. So again, people have gone back to believing that every month you will get 2 to 3% returns in equity, which is not the case. And it is not a certainty that you're going to have every consumer stock deliver 15% per annum kind of returns. That's not the situation. And there'll be periods. We were trying to look at two-wheeler data, and we found that it's almost for 7, 8 years, two-wheelers have given a negative volume growth. And in India, it's so fashionable to say that everything will grow. Why is it for the last 7 years, two-wheeler volumes did not grow? So that's the interesting thing, and that's why we have to be always conscious of valuation. That's why you have to be conscious of asset allocation. You have to be conscious of what is the buy price that you have to pay in different stocks in different sectors. And then it makes it much better, which is why strategies like asset allocation actually always work out in the long run, because there you are much more conscious of asset allocation, and that works much, much better for investors.
Speaking of autos, where are we in the auto cycle now, Naren? Because in your funds, you do own names like Maruti and TVS Motors, but autos give returns in fits and starts. I mean, 4 or 5 years, there'll be very anemic kind of returns, and then 4 or 5 years, you'll get a good cycle. Where are we now, you think?
No longer at the start, as an AMC, we did guess that auto is one of the most interesting sectors to invest in. But if you look at the kind of returns some of the auto stocks have delivered in the recent past, we are no longer at the start of an upcycle. We are already in the middle of the upcycle. And now you have to be much more stock specific in many of them, because they have actually delivered lot of returns. So you have to do much better work to ensure that you don't make a mistake at this point of time. And unlike a year or two back, when you had seen 5 years of bad returns in auto, now we've seen actually 1 to 2 years of very good returns. Having said that, because the industry is actually going through a metamorphosis because of electric vehicles and all that, there are some companies which are doing extremely well and some companies which are not doing well. And that gives scope for us to do a lot of work as an active asset manager to bet on those companies which is doing much better work. And that gives us a lot of scope for us to do a lot of research and work on them.
So if autos are not at the start of the cycle, could it be that farmers are at the end of their down cycle? Because for the last 5 years, nobody's made money on pharmaceuticals. I mean, at one point, most equity funds like you would own the Sun Pharmas and Ciplas of the world in their portfolio, but that holding has clearly diminished. But could it be that we are now entering a phase where pharma has been forgotten for too long?
Yeah, pharma is one of the most interesting sectors. In the last 3 to 6 months, it's been one of the sectors which we have been recommending and telling people is very interesting at this point of time. But even a sector like pharma, which we like a lot, I don't think it is the kind of sector which is going to give you holistic returns. Because the starting point, for returns to be very high, you need a starting point of valuations which is equally low, and then you can get very big returns. And that is missing even in a sector which we like pharma. You don't have a starting point of valuations which is that cheap. That is the challenge at this point of time in the market across sectors, across capitalizations at this point of time. And it's something people don't want to hear, but that is a reality, because we don't have that kind of, always we tell people, you want to make big money, you need fear and valuation being low. If you want to lose big money, you need euphoria and valuation being high. Certainly, we don't have euphoria, at least in the mutual fund industry, because you're not seeing big inflows. But certainly, as most of you would agree, we are not in a situation where there is fear and valuation being low. So how is it you're going to be able to make big money from here? And in select pockets on the direct investing side, you can clearly see that there is euphoria and some of the stocks do go up in select sectors. So that's where we are at this point of time. That's why the investors have to be careful in how they invest their money. And and that is why asset allocation and systematic investing strategies are the two best ways to invest in this phase of the cycle.
It's interesting to hear you sound a note of caution on valuations, Naren, because the counter argument that we hear from a lot of market participants is that you're making a mistake by thinking. I mean, the classic example is capital goods, where stocks have run up and it looks very lofty in terms of valuations. But if you ask stockbrokers, they will say, no, you're making a mistake with this because the cycle has just started. And once the Capex cycle takes off, earnings will moderate these valuations. So you're looking in the rear view mirror and valuations are not that expensive. Is that the right way to look at it?
Actually, on the Capex cycle, things are slightly better. So, for example, a sector like power, which we've been liking, is a sector which we feel that valuations are also comfortable, outlook is also comfortable. There is no euphoria in that sector. So maybe that kind of sector is better. But every sector is not something where you can say that you have had 10 years of growth. So power is a sector. You go back and look, many of the stocks will be where they are in 2007. So 2007 to 23 would be 16 years of no return in some of the stocks. So some of the capex related areas would qualify for the what you said. But think about the scale of those areas. Can we run 2 lakh? We run more than 2,50,000 crores of other people's money in equity and hybrid schemes. Can we create a portfolio of just those kind of sectors for all those money? It's not possible. So we have to be conscious of that, because when we are managing other people's money, we have to be conscious that we can't create a power portfolio of 2,50,000 crores. We can create it for a small part of that. And that is something. But having said that, the capex side of the business is something which is better, because they have had a long down cycle after 2007-8, and therefore that cycle may be better. Yes, valuations are high in some cases, but at least the cycle is more supported.
We spoke about pharma, Naren. What about IT, where there seems to be general pessimism, I would say? Valuations have corrected. Everybody believes that the near terms look very, very clouded for IT. Do you sense an opportunity, or have valuations not moderated enough for your liking?
I think it's one of the best contrarian opportunities, but we are grappling with what is the bottom for that contrarian opportunity. Because that contrarian opportunity normally bottoms out when US goes into recession. So do we believe at some point of time US will go into recession? That's the question we have to ask. We ask most people, they say in the next 6 months to 9 months we'll have it. And at that point of time, maybe the time when you go into that bottom and you can invest aggressively. So till that point of time, a systematic investing into that sector would possibly be the best way forward. And maybe 6 months to 9 months down the line, maybe the best time for you to take a big contrarian investment into them. But the sector has already reached a stage where, as a contrarian, one has to start looking at what would be the best time to invest in the sector.
Naren, always a pleasure hearing your thoughts. Thank you very much for your time today.
Thank you. Thank you.
If you like the video, do like, comment, share, and subscribe.